Good day, investors. Today we are looking at another iron ore producer company from Australia, Fortescue. It's a simple iron ore business, but it's highly cyclical, and it's clouded by new risky green diversification efforts. It would be a low-cost producer, actually the lowest among its peers, yet fully reliant on iron ore prices and have capital-draining green projects. Management is founder-led. The CEO is owning around 35-36% of the shares, but there's been some executive turnover over poor strategic shifts. Margin of safety perspective, so it would be for me a too hard pile. To a degree, we will see. I'll have a more detailed analysis on valuation this time. It's overexposed to iron ore, which wouldn't be actually a problem, but green losses shrink the buffer, and I would put the company above intrinsic value at these valuations. So, as said, it's an Australian company. You can buy it in dollars on the OTC, or you can buy it in the Australian exchange. Market cap is around $42 billion US. Core business is iron ore. We can call it predictable, although not that predictable, and it's highly cyclical. It's expanding into green energy, which adds, I would say, uncertainty, which is, if you think about it, is counter, like it's irrational to a degree. You want to expand somewhere like BHP does into copper, and it gives you an extra hedge or something that gives you money and helps you ride these cycles out. Business is overall understandable, but the future returns are less clear to me, at least. So I'm having a little bit of problem on valuation. Andrew Forrest, CEO, is owning 37% of the company, so that would give you a good shareholder and management alignment, although we'll see about that. And then you have Hunan Valin Group, which is a Chinese state-owned steel group, Hunan Sussex Holding. So China has a key stake in this company. From the segment breakdown, so this is what I'm talking about. We look only 25 numbers for now. Let's say 25 here, 25 here, 25 here. You have metals. So this is metals, iron ore mostly. 8.6 billion EBITDA. Amazing. Of course, 24 was higher because you had higher prices, but compare that with 741 million loss, EBITDA loss from energy, and then somehow they netted a gain on corporate, so maybe it's accounting gain, probably not cash flow, because corporate usually just provides an expense for you. So basically you have the iron mining business that's profitable, and then you have this green shift which is draining money, and it's rather substantial. It's like 8% of your iron ore money is just flying out of the window. Maybe they're gonna turn it profitable with green iron ore sales, whatever that means. I read in articles that China has demand for green iron ore. I don't think they care too much about it, but this would be a really good part of the business, and this is just a drag, as I understand it. As an iron ore producer, you can see with peers, iron ore price goes up, share price goes up. You can see that Forte was having a different dynamic than other iron ore producers because it rose more than the others, and it didn't decline as much. It's more because they have actually some more growth in the segment over the years than its peers, and it's more leveraged towards iron ore because while BHP has more and more copper, Vale had also diversification, and Rio, although each of them are still heavy on iron ore, Forte is just iron ore and some green, but that's negative. So they are more leveraged to iron ore. And the Moat part. So one of the world's lowest cost iron ore producers. So keep in mind that for Vale and for Rio, these numbers are actually 2024 unit costs. And this is 25 and 25 because Forte and BHP reports 2025 annual report is June. So keep that in mind. But comparison wise, it's still okay. And you will, so this return investment is kind of skewing the image because they are really heavy on iron ore, and iron ore was having a really good time in 21-22, especially 21, until the Evergrande bust in September broke the picture. but it declined slowly. On the iron ore prices, they were making a lot of money still. So low cost producer on iron ore. The business is really capital intensive, so you have high barriers to entry for everybody else. No pricing power at all. Prices are set by global markets. And what I find as weakness for them is that they are fully reliant on iron ore while wasting capital, wasting in quotes, on green projects because it's net negative for them. So management, Andrew Forrest is the CEO who holds 37 stake, aligning in theory interest with shareholders. The company's dividend policy is to have a payout ratio of 50 to 80%. But keep in mind that actually executives, including the CEO and CFO in the last, I think, 2023, so recently, left Fortescue. The company attributes these exits to, quote, cultural misalignments, meaning some new leaders didn't fit. So Fortescue, to their so-called fast-moving culture. So the departures occurred because Fortescue's major strategic shift from traditional mining to green energy projects. So from a Buffett perspective, the founder ownership is a plus, but frequent top-level management changes weaken management reliability. So if you're looking at this company, and that's also my take, you have a really good iron ore business, you have top cost controls, competitiveness compared to others, and then you shift towards green, which is not profitable. I don't know how that, maybe it turns out great. It's a bit too hard for me. And this is their long-term incentive plan. On the next slide, I have more details. So they basically say 70% total shareholder return and key strategic 30%. In the past couple of years, they were doing, because of the high iron ore prices, better than peers. So that may be the reason for the TSR high share. So Fortescue, strategic measures, so that the remaining 30% other than the stock price and dividends. So address potential excess, inventory gaps, okay, leading costs, so that's still nice. These are like business, okay, run rate, capacity of new iron ore, that's crucial. Green metal projects, construction, scale, okay. Identify, pursue, exploration. Yes, you need to do that. High grade iron ore, very important, because, for example, in the 62% Fe content iron ore is compared to the 65%, there is a 20% pricing difference. So that 62 to 65, you get a 20% premium. So that's really important to get high grade iron ore. And it's also less energy intense to refine that. 3 value accretive energy projects on track to deliver internal rate of return that exceeds the cost of capital with external projects funding. That's a good guidance. So if they could achieve that, at least that would be a net zero and not negative for the company. Industry average gross margin from product sales, yes, deliver 1 billion of value through AI for the scale. So there is a Buffett attitude that you want to have companies where management avoids trends. So you don't want a company that is renaming itself .com or internet company in the 2000s or now becomes AI. So you want to have a company that focuses on the business. I see them having a really good iron ore business with this energy on green trend and now AI. So I'm cautious on that, which doesn't align, because if you have a founder-led business, you would think they are more practical. On their historical shareholder remuneration and debt, you can see that their debt dropped a lot in 21. Of course, really high free cash flow, 9 billion. And then 3.5, 40. We'll see more detailed numbers this time on these. And then they pay a lot of dividends, really small buybacks. So since 2019, they only reduced outstanding shares by 1%. So they mostly pay dividends. And actually, you see this year, like 2025, they were spending more. In 2022, they were spending more dividends than money coming in. So they don't do what Petrobras does, for example, is that, or even BHP to a large extent, is that when they have money coming in, they just pay it out as dividend, almost everything they don't need. They buffer it, they spread it out a bit. So that's why you see not everything paid out here, but some moved to the next year. And also debt increase in 2022, which I found interesting. If you are paying out record amounts of dividends, you should just focus on deleveraging. Although I'm sure they are trying to be cost efficient and tax shield using debt efficiently, and their debt is pretty low, so it's not an issue. Here is where we will have a couple slides following up on these numbers, so just keep that in mind. And I will explain this intrinsic value calculation on the next slide. So for now, I put the value around 8. Despite their 2025 value of 16, if you would get a 10% return on your money, that would be 16.5 for the 2025 free cash flow based on that. And averaging out 2019 to 2025, you would get 30 value out of shares. Why is that? Because the last out of the 7 years, you had 20, 21, 22, 23, 24 even was not bad. So like you had like 3.5 really good, two really good years and 3.5, 4 years okay. So they are having higher average because of that. So they are profitable, but my question is, are they going to be profitable long term? Because my key risk is structural iron ore demand shift. So if China is pulling back, will anybody else pick up on urbanization and those kind of demands? Or iron ore is just going to flatline around 125, 95, 90, 90. So these numbers, I'm also going to show these assumptions are from reports and multiple reports and outlook. So profitable, look at the numbers, nice return on equity, especially over the past 7 years, because as mentioned, they had really good years. Return investment is same story. Their debt is low, below the 7-year average. Their cost of debt is not horrible. It's 6%. It's Australia. They have a bit higher rates, but it's also still a bit higher than it was on the 7-year average due to rates climbed a bit. Coverage ratio, they are healthy. They were usually really liquid, and they are still liquid. And then you can see the current ratio for them is really high. So they can cover their current liabilities with current assets easily. So they are not going to bankrupt. They don't have much debt, and they are liquid enough. So their dividend forward yield is around 5%. And if you look at the 2025 free cash flow and compare it to the market cap of around $140, like $42 billion, you get like a 6.5% free cash flow yield. So if you compare these two, you get basically the 50 to 80% payout ratio that they are targeting. Commodity prices, huge risk is iron ore. And all these numbers go out of the window when iron ore prices go up. So if iron ore prices go up, the company's valuation goes up. Strategic, I think it's a big risk. You have management, CEO, CFO leaving with your shift to green projects. That's a really big shakeout. So we want to see how that turns out. China demand, is there structural less iron ore demand? With the real estate crisis in 2021 September, iron ore peaked, has been coming down, and miners, actually if you compare 2021 with 2025, miners were on an upscale in production, so they are delayed, they are producing more. So it's not just you probably have less forward demand from China, you have more production, so you have a supply demand play there. And of course operational risks for a company that is mining. So let's look into the numbers. So this is their guidance for 26. They say they're gonna ship this much iron ore, okay? And what I care about for the calculations is this number and the metals plus energy capex. So if you put these capex together and average it out, it's 3,950 million capex. So that's what I'm gonna use. Wait, no, this one plus this one. So let's go there. So let's look. So this is what the capex I'm gonna use based on what you just saw is the energy capex and the and the metals capex. So I'm gonna use the 26 guidance as capex over the period. I calculated a break-even price here. How I did that is I used average iron ore price. So it was $101.25 period compared to 119. So you can see the decline. So I used that number. I put it in here. I used their production number for 25. I put it in here, and I get the production times bracket realized plus minus free cash flow break even, and then I get a CFFO plus taxes, because separately I deduct the average percentage of tax they paid over the 7 years. So that's how I come to this conclusion. So you have iron ore prices from my assumptions of 100 going down to 90 over the years. You have your kind of break even, and then you have your capex, and in the end I deduct the taxes. And then you end up with a free cash flow of around this going forward. If you discount that with 10%, that's when I get my intrinsic value of 8. If iron ore prices go higher, obviously this can go higher. If it goes back just from 100, so just maintains 100, it's gonna be like $16 per share. So it's really an iron ore play. And if you noticed, I don't deduct anything for the green business, as I also don't add anything for this business. So I'm purely valuing this company based on their iron ore business and see how that works out. One noteworthy thing is that this is what they actually realized with their sales. So this is included in my break-even calculation because I want to use projected 62% Fe content. But their mines can be lower grade over their mix, what they sell, lower grade, and so on. And you see that Hamite average price realization relative to this index. So they are like realizing over the period like 85% of what the benchmark price is. So you can see what kind of makes me wonder, like, you are a low-cost producer, but some things don't add up. You say your cost is 18, but I calculate sort of 60 with including everything. So they are also just like separating costs out, of course. And this is just the numbers to just take another look together at them. So if you look at 25, it was 2.5 billion on today's market cap of 42 billion. That gives you a 10 cap value, which is 10% yield, free cash flow yield value of around 60, right? If you remember, I did the calculation at 100 with current capex guidance. 26 should be like 2.2, 2.3 billion, depending on when iron ore prices go. So my calculation is pretty close. We had a bit higher iron ore price, and then we had a bit lower capex, and I used a bit higher tax rate. So this year you had 20% effective tax rate. I think mine is averaging out this period, which is like 23%-ish. So I'm glad I'm there. I replicated their numbers going forward, and I think it should be accurate. At least it predicted this year. And then this number is just averaging out all the years. And they had good years, right? Because if you see, this is the lowest net year. Look at 2019, you had way lower cash flow from operations. You had really low effective tax that year. And then you had a 3.3 billion free cash flow, 4.5, 9 billion. Good years. Even 24 was good, right? So that's why going forward, I don't see these I see much lower free cash flows, 1.6, 800 million, because of iron ore prices and the increased costs. So it's gonna be worse going forward based on current iron ore price projections than it was in the past 7 years, as I see. What's interesting also here is just looking at their balance sheet, right? Debt to equity is nice. They are liquid over the period. So that's where my valuation comes down to like 8, despite their past, because you have iron ore prices going lower. This is that simple. on a summary basis, so it's an Australian iron ore miner with a straightforward but cyclical business. The expansion into green energy adds uncertainty and clouds long-term predictability, hence my too hard pile. So it's moderately predictable, but kind of too hard. It's among the lowest cost iron ore producers with strong infrastructure and export scale. Yeah. However, the pricing is fully tied to global markets. Weakness is full reliance on iron ore prices, paired with wasting capital on green projects. As of now, we know that they want to be make that profitable from the management incentives, but we'll see how that is. So they have a cost moat, but limited, and only limited to iron ore. The founder is a 37% shareholder of the business, yet, so it should be an alignment, yet executive turnover and strategic shift towards unprofitable green ventures undermine the focus on its strong core business. I would love to have that iron ore business. Maybe valuation is a bit too high, but it's a profitable, nice business. Even if China is having structurally lower demand going forward, paired with possibly higher iron ore production overall. So maybe prices will be, as on these predictions, like 90s in the years going forward. If iron ore prices pick up, it goes up. No, it goes down. So that's how I see it. So on a margin of safety, volatile iron ore prices, everything is reliant on them, with a drain of green investments, which reduces the intrinsic value potential. So you want to discount for that. Current outlook, like 195 and 90s dollar per ton iron ore. The stock trades, I believe, above intrinsic value. So it's today around 27, and I think it's like 8, worth 8. Maybe my numbers are not adding up. I've been spending some time playing with the model, thinking if I should use maybe averaging out the past 7 years. But then that's the history. The future is that they're going to produce based on their projections. And I even used for 27 onwards, I used the upper end of their projections to make it like nicer. But I don't see how today's valuation is justified. Maybe the green project turns positive, or iron ore prices go higher, or I'm missing something. But when I do my math and I replicate the previous year based on my math, I come to the same numbers as last year. So I'm going to use that for the next years going forward. One side note, I'm going to have an additional side this time, is I updated my commodity price assumptions. So for gold, silver, oil, everything. So you might see some different valuations here and different upsides. So in general, oil, I lifted a bit for the outer years for 28. Aluminium, I raised. Copper, I raised. So you will see BHP is a bit higher today. I think the value is around 61 after adjusting the copper outlook prices. Gold I also raised, but I don't do copper stocks. Gold stocks for now. So that's kind of it. This is the price assumption. If you want to take a look, feel free to do it. It's really hard for these commodity businesses to do any forecasting. Basically, you want to buy when everything is bad, and you want to buy the best company, the lowest cost producer, and then you can hold it through the cycle for the cash flows, or you just sell at the high. I would do the rather hold, buy and hold strategy. But that's it. If you enjoyed this video, please like and subscribe, and see you in the next one. Take care.